dear students, to the massive open online course on money and financial markets. In today's module, we are going to learn about the evolution of monetary policy in India. The main objective of this course is a brief overview of the evolution of the monetary policy in India and how the RBI had changed its stances in different time periods. The students are going to get a brief overview about all these things. One of the most important tasks of the central bank, that is the RBI, is to keep demand from either growing too rapidly with resulting inflation or too slowly with resulting high unemployment and slow economic growth. Hence, in the economy, policy should be adopted in such a way that leads to a stable growth in aggregate demand. This ultimately helps to achieve different macroeconomic goal variables in the economy. Thus, the policymakers, specifically the macroeconomic policymakers, usually utilize a combination of fiscal and monetary policy to manage the aggregate demand in an economy. However, as time passes by, the policy regime keeps on changing depending upon the needs of the time. Here, broadly speaking, when we conduct studies on the various stances of monetary policies of the Indian economy, we find that there are basically around 4 different eras of monetary policy which have been followed by the India Central Bank, that is the RBI, at different points in time. To comprehend India's monetary policy better, one should look at the legal mandate of monetary policy in India. The RBI Act of 1934 holds that RBI is legally mandated, quote unquote, to regulate the issues of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenges of an increasingly complex economy and to maintain price stability while keeping in mind the objective of growth. The RBI Act of 1934. Upon closer look at this mandate, it is clear that it is a dual mandate. Number one, RBI has to keep inflation under control. Secondly, it has also to meet the credit needs of the economy. Therefore, monetary policy thinking and practices in India have evolved based on these two mandates. So, the 2 key issues as mentioned below, which have remained focus in almost every era of the Indian monetary policy, are as follows. The government have always been thinking as how should the 2 objectives of price stability and economic growth be balanced. And number 2, what policy instruments should be used to satisfy or to meet these 2 objectives, that is price stability and economic growth. So when we try to categorize the different eras of monetary policy, the first era that we talk about is that of the era of development planning. The most important thing to remember is that the monetary policy was subservient to the needs of the 5-year plan. We know that in the Indian economy, the 5-year plan started from 1950-51. The whole idea was that the government of India would use fiscal policy and planning to raise the growth rates and the investment rates in the economy. And the role of the monetary policy would be to accommodate the financing needs of this economy. Some people have always said that monetary policy is basically the penumbra of the fiscal policy that lived in the shadows of the fiscal policy. Therefore, the RBI was expected to help fund the budget deficits, mainly through monetary creation or increasing the supply of money. Now, students, you should keep in mind a very important point that India really wanted to ramp up its investment rate to generate faster growth. This was a period of the period of era of sustained growth rates in the Indian economy. The first year, the second 5-year plan, the third 5-year plan, and so on. But the government at the same time did not have enough funds to invest for those huge investments. So one part of the savings gap was being made through foreign aid, while another part was being made through accommodation by the RBI, that is, by the monetary creation by the India's central banks. Hence, the RBI was expected to help to fund the budget deficits in the Indian economy during this period through the process of money creation. So, and we all know the economic theory tells us that whenever money supply in the economy rises, it results in inflation. So at one end, there was inflation risk because you're trying to flush your economy with more and more of money. So there are inflation risks. But the gamble is that it would help to increase the domestic supply in the economy, and it would in turn put India on a path of low inflation and high economic growth. So this was a gamble which the government really played at that point of time. Thus, under the era of development planning, the goal was development. Okay, that's a goal, while inflation had an overall secondary role to play. So the question to you, my students, are what were the policy instruments that were used to maintain growth and inflation on a certain specified path by the RBI? The RBI Act basically mentioned bank rate as the main policy instrument. Bank rate they considered was the main policy instrument. That was fundamentally the most important instrument of monetary policy as was envisaged in the original RBI Act of 1934. However, in practice, the bank rate did not have a very important role to play because if you put it in another way, the bank rate did not factor in very much because the bank rate, if you look at the number of times the bank rate was changed during that time period, that is from say 1951 to 1971, we can find that the bank rate changed only 6 times. In recent years, just look at how many times the repo rate changes so very frequently in the Indian economy. So we can say that bank rate theoretically was considered to be an important instrument, but in reality it did not play a very, very important role. Instead, the RBI used a direct instrument for credit control. Thus, it was not an indirect monetary policy through an investment rate channel, but rather it was direct intervention by RBI through credit control mechanisms. Now, you can ask me that why did the RBI go for credit control? They went for credit control basically because of 2 reasons. First, to maintain the flow of credit in the economy, that's very important. And secondly, to direct credit to certain specific sectors in the economy, while the planning authority was trying to focus on those sectors. So we can say that at the beginning of the planning period in the Indian economy, the monetary policy framework could best be described as controlled expansion of the money supply, and was determined mainly by a fiscal stance that was formulated against the backdrop of large budget deficits of the government. So, from the time period, say from 1971 to 1985, the monetization of fiscal deficit really exerted a dominant influence on the conduct of the monetary policy in the Indian economy. Therefore, the main task of the RBI at that time was to contain the adverse effects of monetization. In short, the monetary policy in India during that period was completely subservient to the fiscal stance of the central government. Do you think that this era of development planning only had its success and there was no limitations of this strategy? No, that's not the case, because obviously it did have its successes. Because, for example, the economic growth really picked up and India did develop a diversified industrial base. But it did have its share of limitations. By the end of 1960s, India was stuck with very high inflation. Consequently, the high inflation of the 70s as well as a fiscal dominance over the monetary policy led to a new wave of thinking that led to the era of monetarism in India. So the whole criticism of monetary policy in the era of development planning was that the RBI and the government had lost overall control over inflation and the growth dividend was not as high as anticipated. These consequences ultimately led to an entire rethinking about the monetary policy and the inauguration of the next stage of monetary policy thinking, which is basically the second era, that is the era of monetarism. This is broadly in line with what happened with the rest of the world as well. We now focus on the era of monetarism. No economic students has done a course on monetary economics without coming across this fundamental idea put forward by Milton Friedman when he said inflation is always and everywhere a monetary phenomenon. Keep in mind, students, that the RBI had a structuralist view of inflation and that inflation was because of inadequate food and intermediate goods. That is basically a supply side problem. Basically, Friedman or Friedmanites or the monetarists were of the view that inflation in the end is explained by excess money supply and the central bank has to do something to control the growth of that money supply. Therefore, a rethink started in the late 70s globally and in India as well. But monetarism really came into its own in India in the mid-80s. In the year 1985, the Committee to Review the Condition of the Monetary System, chaired by Dr. Sukumar Chakravarti, released its landmark report in which he mentioned that RBI should accord price stability a dominant position in the spectrum of objectives pursued by the monetary authority. Focusing on the objectives under this framework, the present study again referred to the RBI law. It was monetary stability and providing credit to the growing economy. What the report said was that inflation control should be the primary objective of monetary policy, noting that it should not concentrate on growth, but rather that the primary objective should be controlling inflation. This shift was because of the high inflation experience of the 1970s, which led to political instability in India. It was also the result of the overall global rethinking about the nature of the monetary policy. So, the era of monetarism was a landmark era where monetary policy shifted from development planning towards monetarism. Under this approach, a monetary projection was made consistent with the expected real GDP growth and a tolerable level of inflation. The committee also recommended limiting monetary expansion through the process of monetization of fiscal deficit by an agreement between the RBI and the Government of India. Thus, during this regime, the broad money, which is M3, was set as the intermediate target, while reserve money was one of the main operating instruments for achieving control on broad money growth. So under the monetarism framework, the broad goals of monetary policy was to give a stronger focus on inflation, reduce the fiscal dominance of monetary policy, and to step away from financial repression. So students, we come across two very important terms here. Can you tell me what do I meant by fiscal dominance and fiscal repression? Fiscal dominance and financial repression. Now, what is fiscal dominance? It means that the RBI's ability to control money supply, to control inflation, was severely restricted by its requirements to the growing fiscal deficit of the Indian government. And financial repression means, which was another problem, which meant that because of the interest rate control, most of the interest rates was lower than the inflation rate. In turn, the ability of the RBI to manage aggregate demand through changes in interest rate became extremely restricted. So, in the era of development planning, credit control was the main policy instrument, while in the era of monetarism, it was the control of the money supply which became the main policy instrument of the RBI. Now, how did the RBI come to its annual monetary target or the target for how fast money supply should grow? There were three things that RBI considered. Number one, the estimated rate of real GDP growth, because the money supply had to grow along with the growth of the real GDP. Number two, an acceptable level of inflation. The real GDP growth as well as inflation gave an accepted rate of nominal GDP growth, which was used in the calculation of the money supply. And third is income elasticity of demand for money. The monetary target was derived from the real GDP growth as well as the inflation rate and the income elasticity of the demand for money. This framework was quite flexible in the sense that it allowed for various feedback effects. Moreover, the money supply target was relatively well understood by the public at large. One of the biggest obstacles to monetary targeting was the lack of control over RBI's credit to the central government, which accounted for the bulk of reserve money creation. The capital flows during the 1991 economic reforms also created difficulty to control the monetary aggregates. Thus, in the Indian economy, the era of monetarism lasted for about 10 to 12 years, and it was complete breakaway from the earlier era of development planning. In the end, the monetarist era eventually gave way to the next era of Indian monetary policy, was the era of multiple indicator approach. After a severe balance of payment crisis in 1991, India adopted economic reforms which led to a distinct change in the early 1990s in its policy environment, framework, and strategies. The monetary policy then had to deal with traditional issues besides those new issues which were brought about by changing the economic policy environment. Indeed, deregulations and liberalization of the financial markets started casting doubt on the appropriateness of exclusive reliance on money as the only intermediate target in the late 1990s. Against this backdrop, the monetary policy framework in India changed from a pure monetary targeting strategy to a multiple indicator approach in April 1998, with a greater emphasis on rate channels for monetary policy formulation relative to quantity instruments. Abandonment of monetary targeting framework implied the loss of broad money as the nominal anchor. The multiple indicator approach is informed by forward-looking indicators since the early 2000s drawn from the RBI Survey of Industrial Outlook, credit conditions, capacity utilization, professional forecasters, inflation expectations, and consumer confidence. A particularly noteworthy step during this period was a historic accord between the government and the RBI for phasing out the issue of ad hoc treasury bills, thereby eliminating automatic monetization of the budget deficit. This in turn reinforced monetary policy autonomy and enhanced the credibility of the central bank. Although the basic objective of monetary policy of ensuring price stability and availability of credit to the productive sectors remained intact, the underlying operating procedures did undergo significant changes. Also, the emphasis shifted from direct instruments of monetary policy like interest rate regulations, selective credit control, and cash reserve ratio to indirect instruments like repo operations under liquidity adjustment facility and open market operations. Therefore, from 1998-99 to 2014-15, much emphasis was given on inflation and growth with multiple intermediate targets. So students, my question to you is, why did the RBI make such a shift? There were two very important reasons for this shift. Number one, the demand for money function became unstable because of financial liberalization. And number two, interest rates became a more important policy variable than either the money supply or the credit aggregates. On the eve of the global financial crisis, some observers questioned this multiple indicators approach strategy. They suggested a gradual move towards an inflation targeting framework as it is adopted in other emerging countries. Thus, this approach, the multiple indicators approach, also came under attack from many critics who said that this approach was too vague and the monetary policy needed a nominal anchor that should have a single target. The target could be inflation, it could be exchange rate, it could be money supply, or nominal domestic GDP. All these were credible nominal anchors which would help to anchor the expectation of the private economic agents. This was a time when many central banks, first in mainly the advanced countries and then in emerging economies, they started to shift to an inflation targeting framework. Similarly, it was also the time when the global monetary thinking started moving to the idea that the task of a central bank is not just to meet inflation target, but to anchor long-term inflation expectations also. And there was a view that the RBI, with its multiple goals and multiple instruments, could not give credit signaling to the market and the private sector so that it could help them to stabilize the inflation expectation. So we come to the era or the final phase of evolution of monetary policy, that is the era of inflation targeting. In the year 2015, under the governorship of Dr. Raghuram Rajan, the former governor of the RBI, a flexible inflation targeting framework was adopted as its monetary policy strategy, particularly after the report of the expert committee to revise and strengthen the monetary policy framework under the chairmanship of Dr. Urjit Patel in January 2014. We all know that Dr. Patel also went on to become one of the RBI governors. Now, under this framework, a new nominal anchor was announced by the RBI, and that was inflation. Thus, on February 20, 2015, the RBI and the Government of India signed a monetary policy framework which focused on inflation as being the nominal anchor under an inflation targeting framework. Under this pact, it was agreed upon that the RBI will maintain the monetary policy framework while considering also the objective of growth. So the objective of inflation targeting would be primarily to maintain price stability. The introduction of a new consumer price index in 2011, which was called the All India CPI Combined, that is, it combined the CPI of both the rural and the urban India, was used as a representative measure of inflation. Henceforth, the Monetary Policy Committee's exclusive mandate was and continues to be to ensure that headline inflation CPI is within a band of 2 to 6%. That is why India's monetary policy framework is called flexible inflation targeting. It does not focus on a single target number like the European Central Bank. Rather, its approach is point with a tolerance target. In addition, under a flexible inflation target umbrella, the inflation target is aimed to be achieved on average over the business cycle while accommodating growth concerns in the short run. Thus, we come to the end of this module where we see that India's monetary policy can basically be divided into 4 eras. The entire way the monetary policy has been done in India completely changed after adopting the inflation targeting era. The monetary policy framework has changed from the simple era of development planning to the era of monetary targeting framework in the mid-80s, that is during the monetarist approach. And then it changed to the era of the multiple indicator approach in the late 90s. And then to the current era of inflation targeting, which started from 2015. So these are the 4 eras that we discussed in this module. In addition to the above, there are several other approaches to conduct monetary policy. But for each and every monetary policy approach, there are several costs and benefits that are involved and has to be adjudged accordingly.